Understand special IRS wash sale rules affect active traders who maintain an individual retirement account IRA in addition to their trading account. And these special rules can have severe consequences on active traders and investors. When a wash sale is triggered by an IRA trade, the loss is permanently disallowed in your taxable account. There are no requirements to file IRS reporting for gains and losses realized in an IRA, nor a wash sale adjustments made within the IRA account alone. However, if you maintain a taxable trading account and an IRA or Roth IRA, then you are required to adjust for wash sales that occur as a result of trading in all accounts, including the IRA. Now, what happens if you acquire a substantially identical stock for your individual retirement account, IRA or Roth IRA? If you close a trade at a loss in a taxable account and within 30-day wash sale window you acquire the same security or substantially identical security or option contract in your IRA account, this is considered a wash sale and must be adjusted in your tax reporting. Notice that this works one way. The loss occurs in the taxable account and you acquire the new trade in the IRA, which triggers the wash sale. If you generate a loss in your IRA, there are no rules for adjusting that loss for wash sales because it is a non-taxable account. In addition, there are special rules as to how the IRA wash sale is adjusted. And it states that if your loss was disallowed because of the wash sale rule, add the disallowed loss to the cost of the new stock or security. The result is your basis in the new stock or security. Postpones the loss deduction until the disposition of the new stock or security. Your holding period for the new stock or security includes the holding period of the stock or security sold. And there is a major exception here. What is the exception? Normally, the cost basis for the security you acquire which triggered the wash sale would be adjusted to include the disallowed wash sale amount. You would therefore capture your loss eventually when you closed out that new position, barring any additional wash sale. However, if a wash sale occurs as a result of an acquisition in your IRA account, the adjustment to cost basis is not made. This was further clarified by the IRS in ruling 2008-5, and that ruling states the loss on the sale of the stock or securities is disallowed under Section 1091 of the Code, and the individual's basis in the Roth IRA or IRA is not increased by the virtue of Section 1091D. The net result of this is that the loss in your taxable account is permanently disallowed. You are not allowed to later take your losses by adjusting the cost basis of the IRA trade. The loss is gone. This rule can have some serious consequences for traders and investors alike. For example, imagine that you have a net realized loss of $2,500 for the tax year. However, because of wash sales in your IRA account, you have $3,500 in disallowed losses. This means that you will have a taxable gain of $1,000 that must be reported to the IRS even though you actually lost money for the year. Normal wash sale situations, you would be able to defer the $3,500 to a future tax year, but not so with an IRA wash sale. They are permanently disallowed. Also understand brokers do not make these adjustments on your 1099-B because there are different rules for different brokers. These are also different than often to other stock traders. So the key point here to understand is that within your IRA account, you have to be very careful of the stocks you're buying and selling, and probably aim more for long-term investments in these particular accounts unless you're absolutely certain that you can have consistent month or yearly profits.